Today.
Morning, Russ. I'm good.
Good. Beautiful day today.
Oh, yeah, it's amazing.
Good morning, Melanie. How are you?
Good morning.
Thank you for joining us today.
No problem. My pleasure.
So we're just doing a little bit of water cooler chat before we get started. Good morning, Shannon. Great job with the playlist.
Good morning, everyone. Thank you.
Morning.
I haven't heard diamonds on the sole of my shoes before. Are those like golf shoes or what?
They could be golf shoes, yes. They can be any kind of shoe.
Kim Kardashian golf shoes?
I'm sure they sell well.
Yeah. Well, we've got a few minutes and we've got lots of questions that came in. So let's take a crack at one or two of these. So here's a question for us. How does income assessment work for self-employment income? What expenses are added back to income to show real income earned? Jason, what do you think?
Self-employment income. So self-employment income, I think of sole proprietors that don't have an incorporated business or company.
Yeah.
And they report all of their income through their personal tax return. They do report all of the revenue, but typically they write off a lot of expenses. And these expenses can be, proper business expenses, but they can also be a lot of personal expenses. So, the bottom line is any expenses that have been deducted from the income in the tax return that are personal in nature, that are not required to generate the business income, those expenses need to be added back and grossed up. And we'll talk about that.
Yeah, we're going to get into that a little bit deeper. Melanie, what's your take on that question?
Yeah, I totally agree with Jason. I guess it's interesting in that the concepts are very similar between self-employed, sole proprietorships and corporations, because you're going to be looking through the corporations for personal expenses as well.
Right. Yeah. Well, think we can get one more in, Shannon? Another quick one?
Yeah, I think we'll give another minute or so
Okay.
to allow everyone to log in. So if you want to do another question.
Another question that came in
started.
advance, and everybody who's already tuned in, put your questions in the chat. We're going to hammer out as many as we can today. All right, so this one's, how do you assess income of someone only declares $20,000 on their income taxes, but clearly has more than $50,000 a year in fixed expenses, much more than with discretionary expenses? Melanie, what do you think?
Well, it's interesting because the first reaction, of course, is, well, how does that make any sense? How can you have 50,000 of expenses and only 20,000 of income?
Usually when you're in court, you pull the financial statement out, right? Probably most financial statements, people are spending more than they make, and you're thinking, okay, what's going on here?
Yep. And sometimes it's totally legitimate. Sometimes people are spending more than they earn, but the question is, where does that supplement for those expenses come from if it's not income? Is it something hidden, or is it something legitimate like debt or gifts or borrowings from related parties?
Putting it on a credit card, or families giving them money, maybe.
Exactly.
Jason, your take on that question?
Oh, yeah, I would agree with that. On the surface, something looks fishy, right? Like, definitely requires further investigation there, because it could be a signal of personal expenses being written off, or it could be the fact that this person is receiving, funds, loans, gifts from other parties to help support those expenses. So
yeah,
requires looking into.
If you're just joining us, we do a little water cooler chat for 5 minutes before we fire up the live seminar. So don't worry, you haven't missed anything. We haven't officially started, but it's kind of nice to get some Q&A in early. What are we talking about here today, Shannon? What have we got up for our discussion?
So thanks for those who sent in those questions, and we will have another dedicated segment at the end. But yeah, first of all, just want to thank everyone for joining us today and welcome you all. My name is Shannon, and I'm part of the Community Engagement and Events team at Russell Alexander Collaborative Family Lawyers. Also want to say a special thank you to our guest speakers today, Melanie, Russell, and Jason Kwiatkowski, who are joining Russell on the panel today to share their insights and expertise on divorce and income assessments. I'm going to start by letting you know what's on the agenda today and introduce our hosts for today before passing the mic over to our panelists. And as we are presenting virtually today, we do apologize in advance for any technical issues that may come up. Once I pass things over to our presenters, I'll be available behind the scenes for any questions or tech issues. So if you are having any challenges throughout the webinar, you can contact me at shannon@russellalexander.com, and I'll do my best to help you resolve the issue. And I'll make sure to put my email in the chat box for your reference as well. So in this 1 hour presentation, Russell, Melanie, and Jason will be covering the following topics. What is an income assessment? Different types of income assessments, qualifications of expert income assessors, and is a CBV required? Cost of an assessment, how long do they take and information required? Common adjustments to reported income, unreported income and cash, personal expenses, double dipping, taxable dividends and taxable capital gains, related party wages for income splitting purposes, attribution of pre-tax corporate income. I'll also be talking about spouses who attempt to shield income, grossing up income, critiques and common objections, and tricks and tips. And as I mentioned, there will also be another Q&A segment at the end of the webinar. So if you haven't already, please feel free to submit your questions via the Q&A box, and we'll do our best to get to your question during the presentation.
That is a really ambitious agenda. We could spend an hour on each one of these points.
Yeah.
So today's a high level overview. Okay, we're going to have lots of show notes. We're going to give you a big picture here. We're not going to do a deep dive. Sorry to cut you off, Shannon.
Yeah, lots to cover today. Looking forward to it. And yes, also just want to mention that we have had a really great turnout today and have received quite a few questions. So we will do our best to get through as many questions as we can during that time. You'll also notice that the chat box has been disabled, and that's just to allow everyone to remain anonymous. But you can send any questions that you have through that Q&A box or any comments you have for our team throughout the presentation. And we also just ask that you keep in mind that the content of this webinar is to provide you with general information and is not to be considered as legal advice. And as Russell mentioned, we will be sending a follow-up email tomorrow with resources on today's topic. So keep an eye out for that tomorrow. So without further ado, it's now my pleasure to introduce today's hosts. We have Russell Alexander, Melanie Russell, and Jason Kwiatkowski. Starting with Melanie here. Melanie is the founder of Kalex Valuations Incorporated, which she founded in 1996. Throughout her professional career, she has been involved in many assignments for a variety of public and private companies of various sizes and across many industries, obtaining her training at 2 of the largest international accounting firms in the industry. Melanie placed second in Canada on the CICBV membership examination. And Melanie has been active in teaching business valuations and related topics since 1987 at various universities and professional organizations. She also runs the premier preparatory course for CBV students in Canada taking their national membership qualification examination. Next, we have Jason, and Jason is a founding partner and the president at Valuation Support Partners Limited, a professional services firm specializing in providing the business and legal communities with business valuation, litigation support, and exit planning advisory services. Jason is an independent financial neutral and has completed numerous business valuation and expert reports, including income assessments for various purposes. Jason has testified before the Ontario Superior Court of Justice as an expert witness in business valuation and damages quantification. He also has authored many articles and spoken before various professional and business groups. Here we have Russell, and Russell is the founder and senior partner of Russell Alexander Collaborative Family Lawyers. With over 20 years of experience, Russell offers a wealth of knowledge and expertise in collaborative family law. He uses his experience with a client-focused approach by creating unique solutions for each of his clients to enable them and their families to move forward with their lives in a compassionate and collaborative manner. So now that you know a little bit more about the panel and what's on the agenda today, I'll be passing things over to Russell to get started.
Thank you for those kind words, Shannon. Some of the feedback we always get is people love polls. So we're going to do some polls today. It's good to get a sense of where our audience is at in terms of what they're thinking. We really enjoy everybody who gives us their feedback and new topics for our live events. Shannon's going to talk about that in a moment. And we have a record crowd today, almost 200 people signed up, so a really good turnout. But before we begin, I always ask you, Shannon, can we offer our guarantee?
Today is like all of our other webinars. We are offering our money back guarantee. We would never take that away from you.
For the free webinar, right?
Exactly.
And we have applied to have this program accredited by the Law Society of Ontario for CVD credits. But let's make a start and find out where everybody's joining us today. We're going to do a quick poll. What's your reason for joining us for today's presentation? And you're a legal professional, you're a professional in a different field interested in the topic, you're going through a separation and divorce, you're doing some research for a loved one, other, you can put the other in the box. While we're waiting for everybody to vote though, maybe we could do a quick question. We've got lots of questions coming in. I don't know if it's a short one. So does your increased income while being separated more than 2 years be subject to division? I don't know. What do you guys think? It's more of a legal question than an income assessment question, right?
Yeah, in terms of increased income and division, like income is required for support purposes. And
Yeah.
if circumstances have changed after the separation, then, they're supposed to be looked at unless there's a separation agreement that says otherwise.
Melanie, your take on that one?
Yeah, it's interesting because some people think that it's great to relook at income every year, and it is great for the lawyers and the valuators because we get paid every year. But the parties often want some finality and want to control their costs. So revisiting it every year is not, especially for spousal, is not really a practical solution in a lot of cases. So, sometimes people will get into formula maybe, or some way to do this on a more cost-effective basis. But you've got to think about compensatory support issues, which obviously that's a legal issue as to whether anyone's entitled to changes or to share in changes. And then, of course, if the support payers' income goes down, you've got an issue of whether that should be shared as well. So it's a complicated area for sure.
There are some legal issues there. You're right. If the increase of income is connected to the marriage somehow, or the relationship possibly. If it's not, courts may be reluctant to share post-separation increases. But if you're anticipating an increase and you're entering into agreement, like Melanie said, maybe you can put a structure in place, right, in terms of how that is going to play out. But let's see who our audience is and see our poll results today. Thank you, everybody, for submitting your answers. So 45% law professional, 22% other professional, 28% going through a separation and divorce, and some smaller percentages for the other ones. So fairly diverse crowd today, lots of legal professionals, but lots of people learning, going through it on their own and want to learn more. So let's get into it. Jason, what's an income assessment? What are we talking about here?
Right. So the first question, what is an income assessment? This is a good place to start in a session that has a lot of information to cover.
Right.
In order to set the stage, I guess, an income assessment is required to determine a spouse's income that's available for support purposes. That could be child or spousal support or both. And income for that purpose is to be calculated in accordance with the federal child support guidelines. So we got to keep that in mind. And what's also important to keep in mind, and that is that in accordance with those guidelines, income is a gross employment income equivalent. So everyone keep that in mind for the rest of the topics we're going to talk about today. Generally, an expert such as a CBV is needed when there's a business interest involved. If it's just a straight T4 employee, it's a pretty simple exercise. But if the spouse has a business interest, you need to get an expert involved because there are benefits from business ownership that need to be taken into consideration and included in income that's available for support purposes relating to that business. So generally speaking, the process is you start with the individual's gross income reported to CRA in their tax return, and you make certain adjustments that are in accordance with the guidelines. And that's what we're going to talk about.
And same for spousal support too, right? It's incredible how many small business owners have a line 150 income of like 25 grand. And it seems common, but that's not the number we're looking at today. So different types of income assessments. Melanie, what should we expect? I know when we talked about this a week or two ago, you said it was sort of like an onion, right? And how many layers?
Right. So for those who are familiar with valuations, you know that there's 3 different formal levels of reporting assurance. And we don't have formal levels of income analysis that says, here's the high level of assurance, here's a medium. We don't have that. But as Russell says, I like to call it the onion. So, you know, it's how many layers of the onion are you going to peel off? And that usually comes in, it becomes relevant when you're getting into some of those issues we'll talk about. So if there's, you know, a lot of complexities, corporate, a lot of companies or complicated organization structure or a bunch of related parties, you will probably, or are concerns about personal expenses, income splitting. So the more concerns there are, then the more layers of the onion you will often want to peel off. But you will have to balance that against cost effectiveness of peeling those layers of the onion away.
Correct statement, or the donkey and track about the onion. All right, so qualifications of experts doing income assessments. Jason, what should we be looking at here?
Yeah, I guess in terms of qualifications of an expert doing these income assessments, you definitely need someone with an understanding of the federal child support guidelines, right? That's first and foremost. I think you also need someone with experience doing these income assessments for business owners. You know, knowledge or experience with accounting, tax, business valuation issues is going to be very helpful and oftentimes required to get into the issues we're going to be talking about. A CBV designation may not be required. I don't see any requirement, but I'd say
what is a CBV?
CBV, Chartered Business Valuator.
Okay.
Yeah. So that designation may not be required, but I would say more than 90% of the income reports that come across my desk that I see have been prepared by a CBV.
Yeah.
CBVs have been qualified as experts by the courts in this area. So, you know, that is probably the most common professional or expert that you're going to see handling these types of reports.
No, I'll just, if I can add one little comment on that. So the comment from Jason about having experience or knowledge of child support guidelines and the issues involved is really important, because you often have a business owner or a spouse will have an accountant, and the accountant may be very good at what they do. They may understand tax, they may understand accounting, but when they hear income, they automatically default to, well, it's equal to what you say on the tax return. And that's really not the case. So if the accountants, when they're not familiar with the child support guidelines or the spousal support advisory guidelines, they just don't have the basis for understanding it.
And I've had cases where one spouse didn't trust the accountant, right? Like they're participating in some kind of mischief. But I think the points here are really important, right? If you have a qualified expert, it's going to give credibility to the report. And if you don't resolve your matter and you go to court, the court's going to recognize, you know, somebody with the CBV who's testified before and qualify them to give opinion evidence. That's really important when you're trying to say somebody's income's higher than reported, right? Making a statement doesn't mean anything. You need evidence before the court. So really important stuff. Okay, people who've seen these before know I love polls. So we're going to do polls back to back, and then we've got a lot of meat and potatoes we're going to get into here. So what do you expect an income assessment to cost? We've got a bunch of answers on the board. I'm going to do a quick question while people are answering. So this question came in from the audience ahead of time. All right, if one spouse has investments that do not have a return for a few years, is that considered to be split? So Melanie, how's this related to income? What would your response to this be?
Well, I think you have to be very careful to separate the concepts of valuation and property and income and support. If it's an investment that was owned at separation date and the parties were married, then that investment is is equalized, not necessarily splitting the investment, but splitting the value of it.
An asset.
Of the asset, exactly. The going forward impact on support or income will be whether there's any money generated from that asset by the owner, or that whoever remains as the owner afterwards.
Yeah, great answer. Let's see what our audience thinks about the costs here. Some people have been through this, it's new to others. So about 20%, maybe under 5,000, 5 to 10, 20%, 10 to 25, 5%, depends on the facts of the case. I think those are the lawyers answering the question there. And it depends on counsel. Yeah, well, and if trials required, 6%. Those are great answers. Let's run their next poll real quick, because we're going to get into the costs, and we're also going to get into how long an assessment should take to complete. So we're going to go right into these subjects in one moment, but I just want to get a sense from our audience in terms of what their expectations are, what their experience has been with respect to the length of time. One of the biggest complaints about the family court prior to the pandemic was it's slow and it costs a lot of money. And income assessments can be a component of that, but just one smaller component. So let's see what our audience thinks here. Thank you again, everybody who's participated in voting. 1 week, 7%. Well, that'd be great, right? A month, 42%. 3 months, 38%. 6 months, 11%. And a small percent saying 1 year or longer. All right, so let's get into these. Cost of an assessment, how long do they take? I think you're on this one, Melanie.
I am, so thank you. So cost, that's a great, and that 49% of you were 100% accurate. It totally depends.
That's like the dentist, right? 5 out of 6 dentists.
Exactly. So it totally depends, and everyone would like to know how much it's going to be, of course, going into it, but it's really hard to tell you ahead of time unless you look at some indicators. So I'll just give you a few areas that might indicate the cost will be more rather than less. One of them is, of course, the complexity. The more companies there are, the more entities, the more complicated that organization structure is versus being a one-man show, a one-company issue. That's going to be a lot less complex. Number of years that have to be reviewed. So the child support guidelines talk about looking at a period of time, and the court may consider a 3-year period. Sometimes there's a retro claim, and I've dealt with them that go back 8 to 10 or more years. So obviously the longer the period you're looking at, the more complicated it is. Whether you're working with real information that's been, not real, but audited information or reliable information. So if there's any concerns about either the source of the information or whether anyone has verified or how it's been prepared, that will increase the cost. A perfect example, if financial statements are audited versus they're prepared by the support payer themselves, that can obviously create an increase in the amount of work that needs to be done. How free-flowing the information is, or the documentation, or if it's a challenge just to get information. Obviously, when you're working on a joint basis or a collaborative type situation, the information flow should be less of an issue than if it's a contentious court matter. If you're
just on that point, Melanie, right? If you're relying on an accountant at a major accounting firm to produce the information, we've got to wait on that accountant's schedule, right? They may be busy, they may have other requests. So that's sort of something you can't really control when you're doing an assessment, right?
No, and that's an excellent point. And and if you look at right now, if anyone is aware of tax season, try to contact any accountants right now until the end of April or even into May. Good luck. You're going to have trouble getting any information because they're just too busy. And it can also rely on other people's schedules. It may be, an employer, a third-party employer that you need to get some information from it'll depend on their schedule as well. So yeah, good point, Russell. And I think the how long does it take? Obviously, that's sort of the same response as it depends. if you have a very simple situation where someone is a T4 employee, they don't really have much in the way of benefits, and maybe the biggest issue is, does everything get put on their T4? That's going to be a very simple undertaking, and you may not even need a CBV for that, or an income report. That should be straightforward. But again, the more complex it is, the more challenging it is to get the information, the longer it's going to take, and the more years, of course. In terms of information required, the child support guidelines set out some general things, and obviously, tax returns are the first starting point, because any income analysis always starts with the line 150 or 15,000, and then you look at issues after that. But if there's business ownership, you'll be getting into financial statements of the company, tax returns, general ledgers, and various other, and T4s of related parties. So there can be a lot of information required in a complex engagement.
There could be other owners too, right? And then they may be reluctant to cooperate. Third-party corporate officers may choose not to give you the information. So that's a really difficult spot if you're doing it collaboratively. If you're in court, you can get an order for the production, but it creates lots of issues there. But that's really good. Okay,
and that's an excellent, sorry, I'll just add one thing. That's an excellent point, Russell. And sometimes those issues of ownership are other ownerships, third party, are real. And sometimes it's family ownership where the mother, father, sister, brother don't want to get involved or don't want to cooperate, and that may create a little different situation.
Or is the not so silent partner, right? I did a collaborative case, and one of the partners wanted to sit in on our CP meeting. I said, no, right? This is a private matrimony matter, and we had the expert meet with them offsite. I think you might have been involved in that case, Jason.
Yep.
So these are wrinkles that you're going to see and have to deal with when you're getting these income assessments done. So common adjustments to reported income. There's a lot of meat and potatoes here, a lot of substance. Like I said, we could spend an hour on each one of these bullets, but I'm going to try to limit you to maybe 2 minutes a bullet so we can get some Q&A in at the end, sort of a rapid fire overview. And we're going to start with you, Jason.
Yeah, absolutely. Rapid fire overview. I agree with you. Each of these could be dug into deeper, much deeper. So the first common adjustment that we want to talk about is unreported income or unreported cash. So the thing to remember is any unreported income or cash, it has to be added to the reported income and grossed up to its gross equivalent. So this issue of unreported cash is more common in certain industries than others. It's where cash transactions are more prevalent. Industries like construction or contracting or landscaping or even hair, beauty salons or HVAC contractors. Like, think of industries where cash
Sorry, Jason, how do you find the cash, right? There's
yeah,
always
so,
one partner,
right.
One spouse saying, they made cash all through the marriage.
Right.
And now you got to track it down. How do you find the cash?
So how to uncover? So start by asking both spouses of their knowledge of this sort of activity historically. That may tip you off.
Right.
If not, you may need to resort to conducting a more detailed lifestyle or spending analysis by reviewing and summarizing sort of all of the spending and the historical spending over a period of time. Reviewing the credit card statements, the bank statements, summarize the household spending over a period of time, a year, and then compare that spending to the income that's been reported. And if there's a gap, that can tip you off as to the potential for there being unreported cash.
All right,
it's the most difficult and challenging issue to address.
And there's always a spouse who says, yeah, we had an envelope or a box or a safe, or there's cash under the mattress and it's not there anymore, right? There's always a box of cash sitting around in these cases that, mysteriously goes missing when it's time to share it. So what about personal expenses?
Personal expenses is another adjustment that's very common and required to be made. So the idea is that any expenses paid by the business and expensed by the business that are not business related, that are more personal in nature, they're benefiting the business owner and his or her family. Those have to be added back or adjusted to increase the individual's reported income and grossed up to the gross equivalent. We're going to talk about the gross up later, but some common personal expenses that, you know, we typically see being buried in company expenses can include telephone expenses, internet, automobile travel is very common, meals, entertainment, home office expenses, even donations, and sometimes I see personal maintenance and repairs expenses being paid and booked by the business. I think it's important to note that it's not, if there are personal expenses paid by the business, it's not an automatic adjustment. You have to look at how it's being recorded in the books of the business. Because if all of these expenses are booked to the shareholder loan account and then either repaid by the business owner or declared as income by the business owner at the end of the year, that's okay, that's legit. But if they've been booked to the company expenses, then they have to be added back.
And I think it's a good exercise to go through with your client, whether it's a client of the business valuator or the lawyer's client. Say, okay, list out the expenses you think were paid by the business, right? And that's going to provide you with a bit of a roadmap. Say, okay, I'm going to look for these particular items that have been identified. Is that helpful?
Agreed. That's the last point I was going to mention was, you know, how do you uncover this? You start by asking the business owner and the non-business owner spouse for knowledge of this issue and even a summary of the personal expenses. Like, let's get it on the table. Tell us, be forthcoming and honest and tell us what's going on. And then we, as the independent experts, we can review the income statement of the business. We can review the expense categories to see if they seem in line or if there's anything that looks out of place. We can review the more detailed records, the company general ledgers, the details of every single transaction, and we can go through the expense accounts to try to identify items that may require further questioning or investigation. And we just want to see how they're being recorded and have a discussion with the business owner and non-business owner spouse to try to identify.
What's great about that process is it adds credibility, right? So the suspicious spouse is getting a voice. You're going through a list of what they say went through the business, and then you provide an explanation, right? You say, you know, it went to a draw account, or it was declared as income, or it was or it was a personal expense, right? It adds credibility to the final report.
Right.
Great stuff. Right. Okay, double dipping.
Double dipping. Oh my goodness. This is a contentious issue and something we could have a whole session devoted to. So I'll just sort of give the highlight here. Keep in mind, this issue is relevant for spousal support more than child support. And this issue deals with income that has been generated from assets that have already been equalized.
Right. And
whether or not that income should be included as income for support purposes or not. So that's the fundamental question or issue. So what are some examples?
There's case law on that too. I've seen some cases where they say it's a double dip, but I'm going to order it anyway, right? And then other cases go the other way.
Yep, absolutely, absolutely.
But
so some examples.
The key here is to recognize and characterize it if it's a double dip, and then let the court and the lawyers figure out what the consequences.
Yeah.
Really,
so you
go ahead.
Okay. So the last thing I'll say is that, you know, generally there's no double dipping regarding the family business. Like other assets like investment portfolios, marketable securities, stock options. Yes, I've done that. But I guess this family business is an issue. The value of the business has been included in the NFP and equalized. But then the business owner is taking future employment or dividend income from that family business. Does it make sense to exclude that income from the business that the value has already been equalized? Generally, like you mentioned, I think when it comes to a family business, they're considered separate issues: property equalization and income.
I don't have an answer to that question. It's a great question, though. Great work, Jason. Thank you so much. Taxable dividends, capital gains, Melanie, another hot spot.
Sure. Before I go to this, I just want to make a couple of comments just further to the personal expenses and the unrecorded income. Just one note of caution, and I've sort of learned this painfully over the years, that sometimes people are aware of unrecorded income or personal expenses, the recipient, and sometimes they're not. So the cost of getting into this, peeling back many layers of the onion can become very expensive. So it's very important to assess up front that level of knowledge, inform the client about the costs. And I've had clients who've said, I just want to know, I can't go on with my life until I know. So yes, I recognize I'm going to get you to do all this work, and it doesn't matter what the outcome is. I just want to know the answer. So just watch, be careful of that. One other little point, and this goes to all of the stuff we're talking about, is the issue of scenario analysis. So as Jason was saying, and Russell was also saying, that some of these issues that come up in income analysis are really legal issues. And it is really up to the income valuator to not necessarily make a judgment on some things in some occasions, but possibly do scenario analysis and say, if the court finds this, or if it's determined this, here's the impact. And if they determine something else, here's the other results. So into taxable dividends and taxable capital gains, pretty simple, relatively simple area. As Jason said at the beginning, we're looking at sort of everything is sort of pre-tax equivalent. So taxable dividends on the tax return, personal tax return, are higher than what the gross dividends are. So we bring down the taxable dividends down to the gross as a starting point, and the taxable capital gains that show up on the tax return are less, because right now there's a 50% inclusion rate. So when we're doing an income analysis, we will gross up to the gross capital gain by adding back that extra 50%. There is also an issue with capital dividends. So if you've ever heard of capital dividends, they are not taxable, and they usually arise from if you sell a capital property, there's a 50% non-taxable portion, or if there's a life insurance payment, that's another source of capital dividend. So those wouldn't necessarily those won't go on the personal tax return, but they will be cash that comes into someone's hand. And so you have to assess whether or not that should be considered and included in income, or whether there's a double dipping component, as Jason mentioned. There's also a gross up issue that we'll talk about, we'll get to later.
We talk about pre-tax corporate income.
Yes, big topic. And again, this could be, as with most of these topics, they could certainly be an hour session.
We know some people just leave the money in the business so they don't have to pay support, right?
Exactly.
But unless you have an expert saying, that's available to be paid out subject to any, covenants with the bank or anything else, and that's available to be treated as income. Is that right? Am I dumbing that down?
Yes. Yeah. That's exactly it. And that's sort of what, years ago when the child support guidelines came out, everyone sort of assumed you automatically add everything that's in a corporation, because how is that fair if someone happens to operate a business and retain some income, and then they say, look at my line 15,000, that's my income. But over the years, it's become a lot, there's a lot of cases out there that have come to say, here are the kind of tests you look at. And I'll summarize them very quickly, but one of the tests, first of all, was there in income? Like if there was a loss in 1 year, then obviously there's nothing to attribute. There might be an argument as non-cash loss, but generally say if it's a loss, then no. Then you look at really business purposes. Is if there was a pre-tax corporate income earned during the year, what would happen? Does it make sense? Do you have to keep it in the business for whether it's credit agreements or pursuant to shareholders agreements, or is there anything that kind of restricts it? Or do you have to save some of the pre-tax corporate income so you can buy some, invest in growth, replace some capital expenditures, hire new people? So what's the business reason, if any, that for leaving money in or not leaving money in? That's sort of the general rule, but it becomes a little more complicated when you're looking at a longer period of time. And I'm sure Jason's had these situations too, where, the business has a couple of good years and you think, oh, well, they could take out most or all of that pre-tax income. Then you have a COVID year, a couple of years, and there's a loss. So what do you do then? Is that really fair to say you should have taken a lot more in the good years, and then you wouldn't have anything to save for the rainy day of COVID or whatever happens in your particular business?
What I've seen a lot of especially with high income earners and extremely wealthy couples, we're seeing a lot of capital losses being used, lower income for purposes of calculating support, which is really some nasty business, right? Because that loss may have occurred 10 years ago. They may not actually be short that money, but if you're dropping your income from 10 million down to 800,000 because you're applying a capital loss, that could be significant.
Yeah, and luckily the child support guidelines talk about that to some extent. They talk about when you can apply capital losses, and it only goes to the extent of capital gains. But if you're sort of looking overriding that, you look at the cash that's available to someone for the year. That loss that happened 10 years ago isn't really affecting their cash this year, other than they're saving tax.
And this is why it's so important for counsel and parties to use experts like Jason and Melanie. Some people just won't even know to ask the question, right? They'll just see it on the return and assume it's the right number for purposes of calculating support, but it might not be. All right, we've gone a long time without a poll here. I'm going to start getting squirrely unless we do another poll. So let's throw a poll up and we're going to get to some more questions. So what are most of the common attempts to shield income? So this is a great poll. I really want to see what the audience thinks about this. But in the meantime, let's take a question that came in here. Just wanted to see if I can find it. Oh, we had a lot of questions coming in. So just give me a moment here. I have a client who claims her husband is claiming he does not make money and he's a family lawyer. Can a CBB find his claim as underestimated? Who wants to take a crack at that?
I guess I'll put a quick comment in there. Is this the first one or is this?
This is way down there. Lawyers need to report their income or they're going to be disbarred. Like this is I guess the CBV could help, right? Take a look at the books, take a look at the lifestyle, take a look at the expenses, and determine that reported income. It doesn't reflect what lifestyle this person's maintaining. Would you agree with that?
Yep, I would say it's same as for any other business owner or professional.
The fact that you're a lawyer doesn't make a difference. So you're going to go through the same analysis in terms of trying to understand what the income is.
Right.
All right, let's see what our audience thinks about attempts to shield income. And thank you everybody who voted keeping returned income earnings in the company. I find that's always a big one, 33%. Cash, 51%. That's always a hot button for a lot of families. Running personal expenses through a business, 43%. Third-party income splitting, new partners, 25%. Just a comment on that. I had a case where the client was splitting income with his wife. They got separated and then he started splitting it with his girlfriend. And then thinking it had to be grossed up. It's funny the way the splitting of income sometimes working, using capital losses, 19% and others. So thank you everybody for sharing that. And I think that's going to lead us into Jason. What are you seeing here?
Yeah, that was a great poll to segue into this next slide where we're talking about spouses attempting to shield income. I think the high level important point here to mention is that the guidelines, the federal child support guidelines that we follow, they're meant to adjust a spouse's income to reflect the true income available for support purposes. And that includes any uncovering or any attempts to shield income. By all of the things that were mentioned in that poll, by keeping funds in the company, that's through the attribution of pre-tax corporate income adjustment. By having the company pay personal expenses, that's through the adjustment to increase income for personal expenses with a gross up. by not reporting cash income received, that's the adjustment for unreported cash. By paying related parties for income splitting purposes, like if you think you are attempting to shield your income by doing these things, you're not, because the income assessment in accordance with the guidelines is meant to uncover all of these things. Now, if we're talking about, you know, what if you're trying to hide income by not disclosing certain bank accounts or corporate interests or unreported sales activities, that becomes very difficult. And then we get into like disclosure issues and legal issues. And I think, I don't know, the only thing that possibly we could look at there is an assessment of the spending, like the lifestyle analysis, to try to uncover.
Yeah. It can be, you know, pinning some of these support payers down who are actively trying to mislead their spouse, probably their own lawyer, and the court, can be a bit of a daunting task. But I find if you are able to demonstrate that occurred, then there's going to be significant consequences attached to that conduct if you're required to take it to court. Great analysis, Jason. Melanie, grossing up, what are we looking at?
Sure. I just want to make one comment because I think we missed the related party wages, and
Okay,
that probably
sorry.
just required, that's okay. I think that just requires an important note. So just, you know, just because a business or a sole proprietor pays a related party, whether it's girlfriend, child, ex, parents, cousins, whatever it is, does not automatically mean that there's an add back and then potentially gross up. You have to look at the circumstances to see whether that's a valid expenditure. So if, for example, the spouse, the kids, whoever, the girlfriend are doing valid services and that reflects a market remuneration, then no, you wouldn't add it back.
Are they actually doing the work, right? Are they
They're
picking
actually
up the
doing the work.
phones? Are they cleaning the office, or is it just a random title?
Exactly. And that becomes challenging, especially I've seen, and Jason's probably seen a lot of these situations where there's a new girlfriend, new spouse, new boyfriend, whatever it is, and they're being paid. And the automatic presumption from the previous spouse is that that person is not working. And it doesn't, and it's a very hard thing to prove whether they are or are not actually working.
I should have been a little bit more careful in my example. The splitting of the income with the wife, in my example, the wife was doing nothing, right? So when the girlfriend received that income, we just assumed, and we were correct, she was doing nothing, right? Like no tasks were being performed at the business. But that's a really important clarification. Thank you for catching that, Melanie. And I think somebody did mention it in the chat. All right, so grossing up, what are we talking about?
Grossing up. So there's a case that came out many years ago that said, so there's all these issues related to personal expenses, unreported income. Even if you add that back, that person who has taken all the personal expenses out and taken received the unreported income is actually in a better position than someone who is an employee that just gets a T4. Because if you remember the concept, as Jason said at the beginning, that income is based on a pre-tax basis. So we try to equate everything on a pre-tax. So if my client has been taking out $15,000 a year as personal expenses, that is, depending on their tax rate, that could be $30,000 or more. So that gross up deals with that tax savings effectively from deducting or not reporting income. Now, one thing to just be cautious, so there's a couple of issues there. It's one issue is what's the right tax rate that would be added on. But then when you're getting into things like the income splitting, just because there's income splitting doesn't mean there should be a gross up, especially if the person receiving it is actually or getting the T4 is actually receiving the money, then there may not be an automatic gross up. But I find clients are often very surprised that you find $1 of personal expenses, and that means $2 at least added to their income.
Yeah. So let's run our poll. Just a quick comment on the growth up. This could be a significant bump, right? If you discover $100,000, persons in 50 or 52% tax bracket, if my math is right, you know, that's another 150 grand bump to their income. So what you've already had on on the books, right?
Exactly.
Yeah, so it could be significant. So let's do a poll, common objections to income assessments. We're going to leave this up for a moment. We've got some great questions coming in on the Q&A. Thank you, everybody. How is the best way to determine the cost benefit analysis, i.e. is it worth it? It is difficult to determine what the individual income is in the example in this question is a realtor. So I guess the question what they're asking is, how do I know I should be spending the money on a CBV or an expert witness for business income analysis? What am I going to recover? I guess my answer would be, it depends on the lifestyle, right? If you know the person's got, the 2013 Mercedes that just came out and is going on lavish trips, there's probably some evidence indirectly that perhaps maybe they could be financing it, but
yeah, it could be parents could be giving away their inheritance early. So
how do you determine
necessarily.
when to pull the trigger on getting an assessment done? What do you tell your clients?
I tell my clients I don't know. I can't tell you. I can't tell you for sure. But if we go back to peeling the layers of the onion, I say the one way, if you really, this is something we really need satisfaction before you can move forward, let's look at peeling a couple of layers off. And then based on that, let's see whether you want to go further. But if you go all in and peel the entire onion, then you may or may not get the answer you want. And I can't tell you what the answer will be.
Yeah.
Jason, what do you think?
Yeah, for me, I agree with that. And I would start by asking sort of the non-business owner spouse, their knowledge, like how significant do they think these activities are, whether it's personal expenses or unreported cash, how significant? If you think there's a lot because you have knowledge of it or your lifestyle sort of shows that, then I would say, well, then why don't we start with a year, a specific period of time, and see what we uncover. And if we uncover, then we can extend it to a longer period. So you got to sort of take a phased approach to manage it.
We've got our poll results here. Fairly evenly divided. A lot of people are picking gross up amounts added to income do not reflect the available income from the support pair. So we might still be missing some income there. Let's go into our next topic, which is critiques and common objections. So you guys probably, I guess if you're getting cross-examined at trial over a 2 or 3 day period, you're gonna learn what the critiques are. So what are you experiencing? Who wants to go first? Jason?
The critiques and common objections are always to do with one or two of the issues that we've been talking about, right? And it depends on the party you're talking to. If you're talking to the business owner, the critiques and objections are going to be, my income can't be that high. My business doesn't generate income. I don't take that much income to be able to pay the support that's required based on that gross income level. If you're talking to the non-business owner spouse, their critique and common objections are going to be, the extent to which we've adjusted for personal expenses and unreported cash is not high enough.
Yeah.
So
nobody's going to be happy. Melanie, what are you hearing in terms of when you get cross-examined by competent or incompetent counsel? I guess the judges have good questions too.
Yeah, or even the other party, or
Right,
judges have great questions for sure. I mean, lots of things, but one of them, well, of course, not too much cross-examination of me, but kidding. One of the points is a good one that came up in the poll is this issue about gross up. So yeah, you grossed up and maybe I had more equivalent pre-tax income, but I'm going to stop. I'm never doing this again. My accountant has cleaned up. We're going to clean up the books. I promise to do voluntary disclosure, and I will never ever deduct another personal expense or not report income. I've had cases where I had a case that went to court and the judge actually believed the spouse that he would not do that again. But there's lots of people who will say, yeah, you're going to say you won't do it now, but until I actually see it, I don't believe it based on your past history. Other issues, of course, non-recurring sources, that comes up a lot. Yeah, maybe last year was a good year, but that's never going to happen again. That was a once in a lifetime thing, or once in 10 years. So you can't ding me going forward on something that's not going to happen again. That's not fair.
Just on that note, and plus we're in a pandemic, right? Or maybe we're coming out of a pandemic. We're hearing lots of business owners saying, that was my pre-pandemic income, right? My business is dropped. I don't have that income today. And you hear other, is that a objection you're hearing a lot?
Oh,
And
definitely.
how do you deal with it?
Yep.
Definitely.
You average out over 3 years. You say, okay, we'll revisit it. I remember I was involved in a case in 2020, and we thought, well, let's wait a year when we get out of the pandemic, and we're going to take another look at it. And now it's 2 years later, right? So how do you deal with that objection?
I would say that, it's great if everybody is on friendly terms, that you kind of develop some solution, but otherwise it's very tough, because even if you say we'll look at pre-COVID and look at COVID and average, that's not necessarily going to be the answer. So, subject to Jason's thought, I mean, the longer period you look at, the better, but it still doesn't necessarily answer the question of what's going to happen going forward.
Yeah, in terms of retroactive, looking back, I mean, the income you earned in the year is the income you earned in the year.
Right.
But it becomes much more difficult to assess or project what ongoing income is going to be. That's the difficulty. How long is it going to take to recover from this COVID environment, or to get out of this situation, right? So maybe going back a few years longer than normal to come up with an average. Like, I don't know what's best, or maybe revisit it a year later, like you mentioned.
Great tips. All right, so let's go to our final poll of the day. We're going to get into some Q&A as well. So when experts disagree with the appropriate level of income, the party should do. So if you have two experts who disagree, what should the parties do? We have things up there. Give everybody a minute to put their bullets in. Jason, we had a follow-up question to personal expenses that are not automatically no automatic adjustment, that you can look at how it's reported to the business. Can you confirm the different ways the personal expense could be reported to the business?
Just to confirm or reiterate,
like how can a business owner report the personal expense to the business properly? Like, I think he had mentioned shareholder loan, or it was
right.
job.
So what I mentioned was, it depends on how the business pays for these expenses, but is the business owner recording those expenses in the books of the business in an expense category, which reduces the taxable income of the company, and is clearly inappropriate, and that's a personal expense that the owner's benefited from that needs to be added back to income. The other way, and this way is totally kosher and okay, is the business says yes, or the business owner says, yes, I recognize that the business has paid my personal credit card, but we've booked that payment to my shareholder loan account. In other words, I've borrowed money from the business to pay my credit card. I'm going to be repaying that amount. So if by the end of the year, the business owner has repaid that shareholder account, or cleared out that shareholder account by declaring reported income, then that's all okay. So those personal expenses that have been reported in the shareholder loan account, those don't need to be added back or adjusted in the income assessment process.
All right. So let's see our poll results here. Thank you again for everybody who participated in the poll. And what do we got here? Meet in the middle. It seems to be the majority of how you work at different numbers. Ask the experts to hot tub and work at it. The court will do that, where they want the experts to meet and discuss where they disagree, and then we have some other lower numbers there. So thank you everybody for participating. We've got final thoughts, tips or tricks, 1 minute or less. Let's go with you first, Melanie.
Sure. One comment just further to the poll. One option that wasn't put there is maybe consider going to a third party valuator or income and take a look at it. One other comment, one thing closing further to what Jason was talking about, the shareholder loan, that is an issue to be very careful of, both from the personal expenses, as Jason was talking about, but also dealing with overdrawing of the shareholder. And be very careful when you're paying when as a support payer, if you're paying all your legal fees and professional fees through the shareholder loan, through the business, through the share, even if it goes to the shareholder loan account, there's going to be questions about whether you can access pre-tax corporate income because you've been drawing out. And I think one last comment, I just say disclosure is really important, very important for everybody.
Jason, 30
Yeah,
seconds.
quickly, tricks and tips. If you are the counsel or spouse receiving an income report from the other side, keep all of these issues and adjustments in mind that we've been talking about today, and make sure they've been identified or explained. If you are counsel or the business owner preparing the income report or the income assessment, I would say, truthfully, just be as open, honest, and forthcoming as possible. Be reasonable, and generally just be organized with your record keeping. That's gonna go a long way to ensure a smoother and more efficient process.
Great stuff. We're gonna go into Q&A now. Thank you for that. My only tip would be, see if you can agree with opposing party or opposing counsel to use one expert to prepare a joint report for both of you. That's going to avoid dueling experts and potentially a court battle if the experts don't agree. Shannon, welcome back.
Thank you, Russell, and thank you, Jason and Melanie. We hope you've all found that very helpful. We just want to thank everyone for sending in your questions as well. But just before we get into our Q&A segment, we just want to mention that there will be a survey that pops up in your browser following the webinar asking for your feedback. So if you have the time, we welcome and appreciate any feedback you have, as it helps us to continue to grow this series. And as a sign of our appreciation, for those who complete the survey and also give a suggestion on a future topic, we'll be sending you a complimentary copy of Russell's new release of case lines and how to e-file your documents with the courts. So that will pop up once the webinar ends. Thank you all. And so getting into Q&A, it looks like we have a couple minutes here. Thanks again to everyone who submitted questions. First question I have here is, do non-recurring items such as a bonus count for spousal support payment, even though it is not a discretionary payment every year?
Who wants to take that one?
I mean, I could comment quickly. If there's a non-recurring one-time bonus payment, I think that, that's considered income in that year for that particular year. But going forward for predicting or determining ongoing support or income, that can and should be adjusted as a non-recurring item.
That could be a difficult issue too, right? Now, the bonus isn't necessarily going to be the same each year, and sometimes they don't get a bonus, right? So
that's a good point. There may be this may be an annual thing.
Right.
A bonus may be part of the overall compensation. So if it's an ongoing thing, then it's hard to argue it's a non-recurring item.
No, often it could be significant, up to 30%.
And one thing, I'll add on that on the bonus, that may be something.
Go ahead, Melanie.
Oh, sorry, my internet died there. I would say just being careful of or being cognizant of other ways to deal with issues like that. If the bonus fluctuates quite a bit, and if you can come to an agreement on the amount to share on an after-tax basis, you could put that into the separation agreement saying, we're going to base the support on this, on the base, and then depending what the bonus is, once that's determined within however long, one spouse will get X% of that paid on an after-tax
formula.
basis.
Yeah, that's great tip to sort of anticipate that problem before.
Being a little creative.
Okay. Jen, what do you think? Bring the train in the station. We want to get everybody back to off their lunch hour.
Yeah, we just want to be mindful of everyone's time. So that's all the time we have today for Q&A. We hope a lot of your questions were answered throughout the presentation as well. We just want to say a big thank you again to our panelists for joining us today. Thank you, Jason and Melanie, for joining Russell today. And thank you to everyone in our audience. We appreciate your participation and for joining us today. And we hope you found it helpful. And again, if you have the time, we greatly appreciate any feedback you have for our team. You can fill it out in the survey, or also feel free to email me with any general questions or feedback to shannon@russellalexander.com. We host our virtual event series bi-weekly on Wednesdays at 12 p.m. on a variety of family law topics. Our next presentation will discuss advanced topics and common law separations on Wednesday, April 20th, and we'll be including a full list of our upcoming webinars in our follow-up email that will be sent to all of you tomorrow if you're interested in learning more. So thank you again, everyone, and we hope you all have a great day.
Thank you so much, Shannon.
Thank you.
Jason, Melanie, great
Thank
job.
you.
Thank you so much for your time today.
Thanks for inviting us.
Okay, have a good afternoon, everybody.
Bye.
Take care.
Bye-bye.